on RBI policy days, it's like almost like a holding pattern till about 10 o'clock when the decision comes through. And then, of course, there's a press conference later on, commentary, all of it is watched. So it's more tentative till about 10 o'clock, and then action starts to pick up. If you remember the last RBI policy day when the slew of announcements came through, that was a big one. Outside monetary policy, there were lots of announcements. So there were specific moves post all of that. 27-30 points lower, so flat right now, more down than up. That's a Nifty heat map. Shriram Finance, Eternal, Wipro are higher. Reliance, Indigo and Max Health are on the other side. So that's the Nifty 50 picture as it stands right now. Surbhi.
Yeah, I was just looking at Keynes. If there's any reprieve after this conversation, not really. Still down about 2%. That's Keynes for you. By the way, Delta Corp promoters have bought some shares from the market, and that stock's doing really well. Promoter buying usually seen positively, and that's what's happening on Delta Corp. On the large cap screen, we don't have too many, not Asahi Songwon, Delta Corp is the stock, yeah, 5% up. On the large cap screen, not much to go with. Interglobe Aviation is still sulking down about 1%. Reliance, no immediate reaction to that S&P ratings upgrade. Stock's down about 0.5%. What else is weak? Axis Bank, HDFC Bank. Banks are very cautious. ICICI Bank. All of the banks are flat to slightly negative right now. There's Apollo on the way down, JSW Steel on the way down as well. But however, on the upside, let's see what's working. Eternal, 1% higher. Maruti, SBI Life, Eicher Motors, and Kotak Mahindra Bank is actually bucking the rest of the private sector banking weakness. That's holding up, and a little bit of buying on IT. Wipro, Infosys, I can see them bouncing up about 0.5% or so, but absolutely flat. Bang in line with what the GIFT Nifty was indicating. Absolutely quiet. 2 points on the Nifty.
Well, that's right, Surbhi. Delta Corp, that's the one. It's an interesting one in there. Mr. Jaidev Modi going ahead and buying some shares from the open market. The stock is a fourth of what it was, I think 18 months or so ago, before this entire GST fiasco blew up. It was close to around 290 to a 300 rupee stock. So encouraging to see a promoter entity coming in there and chipping in. What else is doing well? Lloyd's Engineering. They have an agreement with the Italy-based Virtual Labs for development of radar tech. Street likes that. Stock higher. That as well has seen a big correction from the recent peak. Railtel, they have bagged a second order this month from the CPWD for around a 60 crore order or thereabouts. So you have Railtel, not 63 moons. Railtel should come up for you on the screen. Zentech, they have got close to around 120 crore order for supply of comprehensive training node from the Ministry of Defense. So that's why that stock is up. And CMAC as well. They have bagged a $43 million order, 5-year charter hire contract from HAL. That one as well, trading well in the green as we speak, 3%. And, there's a sharp uptick as well on that one. Philatex, the court has quashed a GST claim of around 92 crores. I think I saw a favorable reaction on that particular name. A quiet start to trade, but it'll get interesting once the RBI governor takes center stage.
Yeah, no, it's, this news at the bottom of the screen, sobering news. Simone Tata has passed away at the age of 95 at Breach Canning Hospital this morning. That's on your screens right now. Well, you got market open, which is, of course, it's almost waiting and unchanged from yesterday's close. Even with regards to single stock moves, they usually start to appear with some amount of clarity on RBI days post the policy. So that's where we're at. 1:1 is the advanced decline ratio. It's early to look at this, but for what it's worth, we are up a little bit. Capillary, the new listing is, saw that big move yesterday, and it's up another 3% this morning. So it had gotten to about 710 rupees or so. Sorry, 800 bucks was the high, within 3 days. Then it sold off sharply to about 600, and now it's back above 700 once again. Number one volume-led gainer, by the way, Capillary. Grow had a sharp correction yesterday. Grow is down. Grow is up about 2.5% at this point. Shriram Finance, of course, part of the Nifty, is the top gainer. M&M Finance is up about 2.6%. Delta Corp is coming up with a sharp move. So 66 rupees to now 72 in 2 sessions. So that's the move on Delta Corp. On the downside, apart from what we mentioned, Keynes is trying to come up a little bit, but not. It's by the way, the largest volume-led loser right now on the NSE, but it's down 2%. The big correction, of course, is already, happened yesterday and days prior to yesterday. What's happening with HCC? Or am my screen's showing up something? It's seeing a big downtick, but we'll wait. Idea is down about 2.25%. Okay, Idea, HCC down 7. HCC had a big move up yesterday. And that's what we're seeing across random moves. 10% up one day, 10% down the next day.
I think I'm not sure, but I think it goes X rights. I think so.
Really?
Probably. I think today's the X rate of HCC.
Right.
So that could be one of the reasons why it's down.
Yeah, and I think CAMS as well, right? CAMS is showing a big adjustment. So we'll have some of that come up. Okay, India Cement, another one, right? Ended up 10% higher, India Cement. India Cement is down about 3% or so. Hikal is down about 4%. And so it goes across the board. 27 points higher now. 26,060 is where we're at. Kenneth Andrade is with us, CIO, Old Bridge Mutual Fund. Kenneth, good morning. Great to have you with us on the program. Thanks for joining us. Kenneth, just give us an outlay of your views as we head into 2026. Are you more constructive? Many have turned more constructive. But I suspect there isn't this element of just time correction. I mean, other markets have done well, markets have not done very well, and as you can sort of flip the chapter into 2026, expectation that maybe things will look a lot better. Would you kind of agree with it, and how would you back it up with arguments?
Okay, 2025 calendar year, you've been in a reasonable consolidation phase. It's been a time correction. I think you'll have to have a little bit of patience into 2026. What you see right now is the breadth of the market actually becoming weak. I think for the first quarter of next year, this cycle will continue. The headline indices might hold steady, but I think the breadth of the market might continue to get slightly weaker. I think the good news is that we've come out of 2025, 23, 24, 25 with single digit headline numbers. There, I think we're looking a little promising as far as corporate India is concerned, and I think growth should head back in 2026. Second half of 26 and 27, I think we should be much better. We have a much better outlook than what looks like it now. So I guess the time correction that we've been through for a while, as we head into the end of the financial year, I think you'll see a little bit more of that before things ease out a little bit.
Mm-hmm. Okay, hi Kenneth. Good morning and good to see you in. What are the themes that you're identifying? You're sounding a little bit more optimistic that this time-wise correction gradually will move behind, and actually it could be a good time to get into stocks you like. That said, what's the top theme that you all are betting on? I think in the past we've spoken a little bit about defense, you've spoken a little bit about real estate as well. I think you had a bit of tech, if I'm not mistaken. So your view?
I think it's pointing out towards what's happening to the currency, and that's essentially where we have been positioned for a while. There's a domestic economy which is discretionary consumption, and there are companies that are growing international franchises. I think that's where we are. Valuations, capex-led growth. Capex-led growth are basically two thematics that we think on a financial standpoint is what we like. Any business that's putting capex to work or at the end of its capex cycle, we think pharmaceuticals is there. We think automotive is there. Metals should go through that cycle in a year and a half. You should see significant volumes coming through that entire pack. I think that's where we are. Real estate, there is enormous amount of supply coming in across the country, but this market will get consolidated. I think consolidation is the theme in real estate. We've seen prices top out. But now we're going in for a volume drive. So given the little bit of everything that is there, I think the domestic economy is going to hold up. You're not going to see too many negative surprises. The upward surprise comes in with all the negatives of 2025 actually balance themselves out. So the big negative of 2025 has been our trade. I think 2026 trade balances should look a lot better than what they look at this point in time.
All right, let me probe you a little bit on the metals pack. As you said, a couple of pockets could look up. I was just looking at the data points with regard to aluminium, where growth is expected at around 3.5%, and supply may not keep up. And after a while, we could see a bit of a deficit on aluminium. Just to probe you a little bit on the metals, what you like, ferrous, non-ferrous, and from either segment, I mean, what do you more focus on? For example, ferrous, is it more longs? In non-ferrous, is it silver? Is it zinc? Aluminum? What is it?
We've got a little of everything out there. I think our exposure to commodities currently is at about 12%.
Okay.
Ferrous, aluminum, and zinc all put together. Ferrous, we're looking for more diversified geographies. Non-ferrous, which is aluminum and zinc. Aluminum is obviously a trend which is more value-added in nature, and zinc, obviously, they are all primary metal companies. So it's not. I mean, one is commodity prices that should give you your upside. But over the next 2 years or 3 years, you're also seeing a lot of capex in that cycle coming to an end, and capacity is coming on. So whether you get a price, which is your upside in the near term, or whether you get volumes in the next couple of years, I think we're pretty much well placed on both counts. If you get price and volume put together, I think then you're hitting it out of the park with this category. But that's not what we're accounting for. We're just looking at companies putting capital to work and sensible capital to work. We're waiting for capacities to go on stream. These businesses are very capex in nature, and when capex comes on stream, their ROIs are low double digit. I mean, they earn lower in the first couple of years, and as time goes by, their efficiencies and inflation actually adds back to ROIs. So that's the cycle that we are in. It's not about 6 months. It's not about year. It's not about commodity price. It's just capex driven. It's just capex driven investment that's leading volumes in the cycle.
Going by the description you gave me, zinc, aluminum, it looks like you're betting on the large conglomerate that has a little bit of all. Is that correct? That's undergoing a corporate action?
I mean, there are very specific plays out there, but as a category, they should do well. I mean, if you step back again, you can't have capex cycles going through without all commodities doing well, right? When you sit back and look what's happening across the world, everyone's trying to build capacities internally to be self-sufficient. And that's essentially what the world is going through. You're going to go through a small capex cycle, and all commodities should work well.
I think, Kenneth, morning. I think Nigel's basically asking you, do you like Vedanta?
Well, we got an exposure to all businesses that we like.
Okay.
Yeah.
Okay, fair enough. By the way, I was glancing across Asian screens, and it's largely red, barring mainland Chinese markets. And there's been a very interesting listing in China this morning. It's called China's NVIDIA. It's a company called Moore Threads, and they make these graphic processing units. It was a $1 billion listing this morning. Stock's gone up 400%. It's astounding. 5x on listing. That's what's going on. That's the tech craze for you. But Kenneth, now we don't have these AI plays. So let me ask you about the next best thing that the market was fixated on all through this year. Anything related to technology in India. It could be consumer tech. It could be a lens cart. It could be a urban company. Of course, you have Swiggy, Zomato, or payments tech. We had Pine Labs listing. So we don't have AI, but anything else on the tech side, new age tech, the market really latched on to. What are your thoughts around some of these businesses and the valuations at which they trade now?
I mean, everyone's got an opportunity out there. It's all about execution, and it's all about managing cash flows over the long-term cycle in some of these companies. They've done well. They created franchises, and I think they will continue to grow. We're a little different in terms of our thought process in trying to capture businesses. We like cash flows. We like companies that have demonstrated capabilities and their ability to grow with internal cash flows, right? So we watch these companies. We're fairly positive on the franchises, but they're not anywhere close to where we would like to acquire them from just a valuation standpoint. Either they have to grow dramatically, or the stocks have to correct. So one of the two things will happen over the next couple of years. But I'm sure these companies are going to be around for a pretty long time. But we have no investment view on most of them.
Okay, not so interested. What about IT services, legacy IT services? That's the debate, and we've been having it with so many different brokers. Two are fairly optimistic. And this morning we spoke with Nomura, and they also said that incrementally they're turning more positive on IT. There's also the rupee tailwind. And maybe, ultimately when AI moves from the build-out stage to the adoption stage, then our large companies will know how to use AI to their advantage. So, that's the new thesis in the market. Do you subscribe to that view?
We've been holding on to that for a while. Exposure into IT services has been around 10% for a while. And we've got valuations in our favor, we've got cash flows in our favor. And some of these companies are migrating towards what you've just mentioned. And it's been a continuous process. So here you need a little bit more patience. I think most of it will come through sometime in the next couple of years. But I must say, going into the future, there are significant challenges in IT services. It's not going to be a universal shift. It's not going to be universal. All companies are not going to benefit from whatever is happening in artificial intelligence out there or in automation out there. There'll be few that will take significant market share. I think you'll have to identify them in this cycle itself.
Got it. So you like, Kenneth, just to wrap it up, you like metals. What else sectorally?
Okay. Just to wrap it up, any business that has got a reasonably large dollar exposure, even if it's in the domestic environment, is what we like. See, India's been struggling for growth in the domestic environment. We've had a tailwind of policy which has held up the economy for a while. But to find that growth, we need to find new markets. I think that's the cycle that we've been aligned to. So any business which has got a large tailwind in terms of a franchise getting created outside the country with domestic cash flows, I think that's what we are aligning to. So to put it simply, thematically, the market, if it has to grow sizably, we need to create Indian companies that create franchises out there. You've got a number of industries who are already established. You've got a huge amount of capex that has already gone on the ground. I think the utilization of that capex that is on the ground has to come from newer geographies, newer markets. If India holds up, I think that's if India holds up and creates that demand, I think that's a topping. But we need to move the scale significantly higher than where we are today.
Okay, all right. Thanks very much for that. Appreciate it, Kenneth, and good luck. See you in 2026. Well, Sudarshan is now joining us on, Interglobe and some of the brokerage calls which are coming through. Morgan is one of them, but I think there are others as well. So take it away.
So most of the brokerages have maintained their positive stance on Indigo despite the problems that the company has been facing for the last few days. Citi has maintained positive stance as well as the target price, but Morgan Stanley has maintained positive stance of overweight call but has cut target price to 6,540 from earlier target price of almost 6,700 per share. It says company has been seeing the increase in the cost headwinds and it believes the entire industry is going to face the same going forward, and it expects AFS to rise gradually as a partial offset because demand trends in the month of November had seen a significant increase if you compare against last few months. But it has cut FY27 and FY28 EPS estimates by 20% each. And as far as the valuation is concerned, currently Indigo is trading at 9x FY27 EV EBITDA versus pre-COVID level of 8.5 times. It expects Q3 yield to see a growth in Q3, but in Q4, yields are expected to decline on a high base.
Okay, all right. Thanks a lot for that, Sir. By the way, Kaynes Technology is the stock of the morning actually on the downside. It's down 6.5%. Slam dunk on there. Keep in mind that that's a stock that's already down close to 25%. The management acknowledging that there are some kind of lapses, but they're assuring us in the way ahead, things should actually, improve. So, that's the stock that we're actually keeping an eye on. I don't know, at times I think the management, when they know a couple of sell-side analysts are already pointing out some of these facts, why don't you come to the table and, in fact, speak to the analyst community? Because today, in fact, any kind of bounce is getting sold into, for the year to date, it's down. But I think the pain that you're seeing in the last 30 days itself where the stock correcting 30% or thereabouts, and they're now addressing concerns after the stock is down 25%, not giving you a good feeling. Yeah. Management is saying they're going to rectify things, but for the time being, I think there is some intense selling that we're seeing this morning.
No, absolutely.
And I'll just like to point one more thing, right? We usually, absolutely point taken, Nigel. We spoke with the executive chairman, right? Obviously, he knows everything about the business, but usually we have Mr. Sampath, right? Who comes on and he talks about specific numbers, etc. So, to push out at a time like this, someone who usually is not talking to us every quarter, on numbers, etc., etc. I don't know how that makes sense, but that's the other thing I saw. I mean, but we'll try and have Mr. Sampath on as well. But the point is that we spoke with someone who really, we never...
The market's not seen that phase before. And also, I think, the market is not comfortable if a stockbroker or a market intermediary has to come out and point out an anomaly in the way the accounts are being prepared. And then the management does acknowledge, though the gentleman said that it's only one line item. But even then, I think that just makes you feel a little uneasy. And this is a very widely owned stock. So perhaps there's just that disappointment that's played out.
And at around 5,500 rupees, they came on in the middle of this year itself and they raised some money by the QIP route. So that's why those shareholders will be wondering what's going on.
Yeah.
The stock currently is sharply lower in a matter of a few months. Came to I think 5,500 rupees in June, July, if not mistaken, 2025 itself.
And it's very clear that stock exchange clarification that's gone, the point-by-point clarification, that's not really, worked to soothe nerves at all, and there's enough ambiguity.
Yeah. No, what we'll do is we'll try and have maybe we can play out a soundbite of Keynes if we have. We spoke with them just before markets opened, so that coming up in a bit. Okay, I think we have it.
Astral?
So let's just we have Astral, I think, right, guys?
Yeah, I think we have the Astral management joining in. Now, the stock is down about 30-35% overall in the year, but the company had a good second quarter. There is obviously that question about overall demand and whether we'll see a recovery in the second half or not. And now we have the company management joining in. We have Mr. Hiranand Savlani, Executive Director and CFO at Astral. Mr. Savlani, thank you so much for being with us. So we want to focus on three key points. Let's put them up for our viewers. The fact that there is still no anti-dumping duty for PVC and how that's playing out. We need to, of course, understand what is happening with the second half for demand and pricing. And then, of course, the capacity expansion, also the backward integration that Astral has announced into CPVC resin. So let's take all of these points one by one. Mr. Savlani, let's talk about this lack of any protectionist measures so far. So as of now, there's no anti-dumping duty. Are you hopeful it'll come? Is it still required? Tell us what's happening with respect to imports. What is happening with domestic PVC pricing?
So anti-dumping duty, time being, it is postponed. So still there is a hope that it will come maybe in the form of anti-dumping duty or maybe in the form of MIP, minimum import price. But it will take some time. So it is very difficult for us to give that guideline that by when it will be there.
Okay, let's talk pricing, sir. Just explain to us how pricing is in the market. Is there a lot of, are there a lot of imports still flooding the market? What is happening with local prices? Have they stabilized at all?
So in anticipation of anti-dumping duty, the raw material price has gone up. But now, since the anti-dumping duty is not coming, so because of that, the prices have cooled off. So prices have come down. And we are of the view that it is going to stable down near terms. Maybe 1 or 2 rupees here and there will be there, but otherwise it will go down. Because today's pricings are such that the raw material manufacturer are bleeding right now. Even last quarter number, if you see the raw material manufacturer, they are bleeding. So at some point, somebody will stop the production. So because of that, we are of the view that these prices of raw material are not acceptable because that is the bleeding to every manufacturer. So sooner or later, temporary phenomena will be there, that fear is there that the dumping can happen from the China. But actually, if you see, the Chinese players are not giving the lower price than the current price. So I don't think any challenge will be there. Sooner or later, prices will stable down. And from here on, we are seeing that the prices have come down. So demand has already started picking up. Last 10 days, demand is robust. So we are of the view that whatever guidance we have given, that minimum double-digit growth for the full year, we are confident that we will be able to deliver that number.
Okay, all right. Hi, sir. Good morning. Good to see you again. Can you quantify the company's exposure to the Jal Jeevan mission-related projects? Do you have an exposure?
No, we don't have a Jal Jeevan exposure.
No exposure at all. All right.
No.
Since you were focusing on demand, let's get that out of the way. The second half of the year, volumes would be much better. And I think for the year, you were guiding for double-digit revenue growth. You're sticking by that? You want to quantify it?
Yes, we are stick to that, and we are confident that we will be able to deliver. You see, last quarter also there was no anti-dumping duty, but still we have delivered a good number. So we don't see any challenge into delivering the double-digit number.
So double-digit, you want to quantify it? Mid double-digit?
I think let this quarter settle down and prices where it is going to settle down. Based on that, we will be able to guide. So maybe Q3 end, we will be able to guide, because historically, you see Q4 is always robust in our industry. And same thing with the Astral. So we will be able to guide you maybe by the end of the Q3 number.
Okay.
Sir, just want to understand what your outlook is on margins, because you just said that PVC pricing is largely going to be stable, even without any anti-dumping duty. You did about 16% EBITDA margin in Q2. Can you tell us how this will play out? And also then, as you get into the next year, you're going into backward integration with this CPVC resin facility that you're setting up. So just give us a margin outlook over the next few quarters.
I think this year we have already given the guidance of 16 to 18% EBITDA margin. So we are stick to that margin. Definitely next year onward margin will shoot up because of the backward integration. You see the CPVC manufacturers margin, which is already there in public domain because all are the listed players. So they are working very high margin. So even if we maintain the same margin to Astral, it is going to be a game changer for Astral. But I don't want to speculate too much at this stage. Let us plant be operational. We see the actual number. Right now, whatever the numbers are there, only on the paper. So once this will be there, we will be able to guide how.
And when, sir? When does the CPVC facility, when does it come on stream?
September, our plant will be ready. October, November, December, we will try to settle down and do the trial runs and all this thing. From 1st January, maybe little early, commercial production will start.
All right, so give us some more color. Will that be an inventory loss for the quarter? And also, if you could help us out with the EBITDA per kg for the full year, what should it look like? If a rough number you could help us out with?
So I think we have never ever given the per kg EBITDA number to the street. We always say the percentage term. It is very difficult because the reason is that the product mix keeps changing quarter on quarter. In the monsoon quarter, the product mix will be different. Our peak quarter, Q4, the mix will be in favor of CPVC on, so that always will be higher per kg. So we never give the guidance of per kg basis because of the mix. But otherwise, percentage term EBITDA, whatever we have given the guidance, we are stick to that.
All right, Mr. Savlani, a short but crisp chat. We have a lot more questions. Please do join in sometime towards the end of this year or early next year. Thanks a lot for joining in.
Thank you.
Wishing you all the best. Well, time to slip into a short break, but on the other side, we begin our coverage on the RBI monetary policy, which is set to be announced at 10 a.m. Ritu, Lata, and a whole host of economists are waiting for you on the other side of the short break. Stay tuned.
Hello and welcome to the Reserve Bank's monetary policy, coming to you from CNBC-TV18, straight from the Mint Street headquarters here at RBI. It's a very, very tricky policy because before the policy we got a huge GDP number and we are seeing the rupee lose more than 2% in just 2 weeks. So suddenly the policy has become extremely tricky. One sign of the trickiness is that when I did my Citizens Monetary Policy Committee, the CNBC-TV18 shadow committee as it were, we got a 3-2 poll saying they want status quo. Narrow majority, but still a status quo. But my colleague Ritu, who's waiting by, when she did her poll with a large band of economists and bond dealers, she got a 60-40 saying there will be a rate cut. Again, narrow majority. Well, with that, it's over to you, Ritu. Welcome to this monetary policy show. And tell us what else your poll said.
Well, Lata, it's deeply divided, like you said, so it's going to be a close call. 60-40 is what our poll is showing us, 60% in favor of a 25 basis point cut, whereas the rest are betting on the MPC staying on hold this time around. But irrespective, the easing cycle is going to be very short. At best, we're going to get one more 25 basis point rate cut, so not much to write home about. In fact, 60% believe that December will be the end of the rate cut cycle. And the rates, the terminal policy rate will settle at around 5.25%. Now, GDP, that's the number we're going to be focusing on. Of course, RBI will have to revise it. We already have 8% for the first half of the year. So that 6.8 is likely to be revised to 7.1 to 7.2%, according to our poll. And the CPI forecast, 2.6%, is likely to be revised downwards to closer to the 2% mark. No change in the stance is expected. The tone is expected to be a bit dovish, acknowledging that headroom from inflation, which is at record lows at 0.25% the last reading. As far as the rupee is concerned, now that is complicating matters, but our respondents say, RBI is not going to be influenced by the falling rupee just yet. In fact, it may show some comfort. What it does on liquidity is also something that the markets will very keenly watch out for, because remember, there will be withdrawals from the system, in this December to March period. So they want some comfort from RBI that there will be some maybe bond purchases or something of the sort.
Oh, yes, you said it. Actually, the last one, which Ritu pointed out, will be perhaps a point that the market will look forward to very keenly, whether Reserve Bank comes and buys bonds. So that will push down yields, that will give liquidity to the system, and that may be the most important to watch. So it may not come in the policy statement. The liquidity announcements, like an OMO, normally come in a separate press release. So at the end of the policy, we may not yet have a clear understanding of the liquidity. But we have our experts to guide us. Joining us are Parul Mittal Sinha, the head of Treasury at StanChart. We are also joined by Kaushik Das, the economist from Deutsche Bank, Indra Nilpal, the economist from Yes Bank, and Lakshmi Iyer, who is now Group President, Investments and CEO at Bajaj Alternate Investment Management. Ladies and gentlemen, it's an even house. Thank you very much for joining us. Parul, first, what the market wants. Tell us if there is a cut, and if there is a no cut, how bonds will react. And more importantly, whether now, because of the rupee, the Reserve Bank has to be a bit careful. Because this year, we have 17 billion equity outflows and 8.5 billion bond inflows. Do you think the governor has to worry about the rupee angle also while setting rates? So two questions to you.
Yes, Lata. So thank you for inviting me. Like you said, this is a very tricky policy. And this time, the market sentiment is driven more by fear than greed. So normally we have greed driving market sentiment. And why I say that is because market pricing, if you look at the OIS curve, is pricing in a 40% chance of a rate cut in this policy, not even more than 50%, which means market is really fearful that with the strong GDP growth number, RBI may not deliver a rate cut. We at SCB feel also that RBI may not deliver a rate cut and want to keep their powder dry. One of the main reasons may be the rupee depreciation, that it is depreciating very sharply, and it also has implications for inflation going forward. Now, if the rate cut doesn't happen and the commentary is not sufficiently dovish, I think markets have a room to sell off by 10 to 12 basis points. If the rate cut gets delivered, it will be a positive sentiment, but yields may go down only by 2 to 5 basis points. So asymmetric reaction on the side of fear.
Okay. Oh, that's very precise. Thanks for helping us out with that. Kaushik Das, over to you now. And I mean, I'm not asking you to defend a rate cut or a rate hike action. My simple point is that considering that we have $8.5 billion of bond inflows, the idea that India is a growth country and not a rate differential country, perhaps that argument is not holding. Maybe the rupee becomes important, you think, while setting rates?
No, Lata, we are of the view that RBI always keeps interest rate policy and FX policy different. And if you remember, in the beginning of this year, when rupee was going towards 88, at that time, the all-time low, the same question was asked whether RBI should be cutting rates. That was obviously the start of the cycle. But the same question was asked that rupee is weakening, whether RBI should be easing rates, can it lead to more financial sector problems? But RBI went ahead and did 50 basis points rate cut. And when the flows came back between January to June, we saw in May rupee coming back to 84. So rupee, I think, will be a different, discussion altogether. RBI will decide the levels. And also, depends on how much flows come in compared to the current account deficit, rupee will, find its own value. And RBI has been prudent to kind of let it find its own value, but just, taking care of excess volatility. So I think the rate decision today, we are in a favor of a rate cut call of 25 basis points. The bond inflows that have happened can continue next year as well. If you have bond index inclusion, which we're hearing that there's a possibility that India could get included in another global bond index, which can bring in, 15, 20 billion, depending on when it is starting. So I think, the rate cut will be, if it is delivered, it will be delivered because there is so much space on the inflation front, which RBI will have to revise quite significantly, not just for this year, coming down to 2%, maybe next year also the 4.5% that they've given, that has room to come down. So from a real interest rate perspective, RBI has space to do one more rate cut. And the timing is more important. I think, if you're not doing it in December, when inflation is at 0%, it's difficult to justify more rate cuts in February.
Well, Kaushik, of course, we'll watch out for that. And RBI is a forward-looking central bank because monetary policy acts with a lag. But Lakshmi, not asking you your rate call, that's very close. What I'm going to ask you is more on liquidity. What will the markets want to hear from the governor, if he doesn't announce an outright OMO? What are some of the cues you'll be watching out for in the governor's speech?
Yeah, hi, good morning. So I'd say that the markets are very much akin to what Cinderella's wish list was. Cinderella never asked for a Prince Charming. She actually asked for a day off and a pair of shoes. I think the markets, specifically the bond markets, are clearly asking for some liquidity infusion. And I would say on a more sustainable basis, given the fact that because of RBI intervention and, of course, GST, etc., there has been a liquidity outflow. And I think on a sustained basis, that is going to be the key. So today's narrative, either which way, as you rightly said, is going to be so close, but is going to be more focused on how much is it going to be through, FX buy-sell swap? Is it going to be more of OMOs, which is what the markets are expecting? I think that is going to be the crux today. Not so fussed about the rate action as is evidenced by the OIS curve.
Mr. Indranil Pan, not so fussed about the rate action, of course, but either way, we're unlikely to see much of a reaction as far as the bond markets are concerned with just one more rate cut priced in already. What are you going to be watching out for?
So I think, as most of our panel members did point out, liquidity and the announcement on the liquidity is likely to be more important than the rate cut at this point in time. I am not expecting an OMO calendar in this policy, and the OMO calendar can come whenever it is necessary and when we clearly see liquidity being on the tighter side. The RBI has allowed the currency to move and establish in a new range, which necessarily means that they are not really possibly too keen on sort of stopping the depreciation pressure on the currency, and therefore worries on the rupee liquidity side due to that is possibly reduced. On the liquidity front, I think the markets would be looking at very clearly the guidance in terms of the amount of rupee liquidity that they want to maintain on a regular basis. And I think they will not change that 1% NDTL sort of direction that they had been providing previously. And as I say, the bond purchases on the OMO side can continue on the secondary market rather than a calendar coming out.
Yeah. Okay. Okay, but then the market is expecting something like over 2 trillion. So there you will have to do a proper OMO auction. Otherwise, I don't know if in the secondary market window so much can be, is usually, bought. But Parul, there is this other point that Lakshmi is making. Are you expecting that they could also announce something like an FX swap, which may come in the statement itself?
We don't expect that kind of liquidity measures to come with the statement itself. We know that the buy sells had reduced in the secondary market, but that is not the expectation. I do think market is expecting some kind of comfort from RBI on the liquidity front. I also want to mention that the stance will also be very important, because if the stance remains neutral with a pause, then it will be really disruptive for the market. But however, the stance, if that changes, that can give a lot of comfort to the market, and then rate cut becomes less important.
That very few people have raised that issue with us about stance. So I think we'll have one more question time. Kaushik, is there even a possibility? 2 external members actually asked for a change of stance in the previous one, in the previous policy. Are you expecting that, or is there even a small chance of that? And secondly, how important are these GDP and inflation forecasts? Suppose they didn't make the GDP as high as the market is expecting, 7.4 or 7.5. Then do you think that's a dovish signal, that they don't give a very big growth signal, and even the inflation number is lower than 2, for instance? Say it's 1.9. Would those be treated as dovish?
So, Lata, very good questions. On the GDP front, I think what's more important is the future growth forecast, not for this year. This year, it's known that it will be above 7%. RBI is forward-looking. I'll be more interested to see the FY27 growth forecast, which is at 6.6%. Whether that is pushed up to 7% or that stays at 6.6. And, if you see RBI's forecast carefully, the last time that they gave the quarterly forecast, from October, December onwards, all the forecasts were 6.5% or lower up to, July, April, June. So I want to see whether RBI is revising up that above 6.5 or keeping the forward-looking forecast at the same level. If the forward-looking forecast for FY27 remains at 6.6, that means, your growth is still below potential. And your inflation next year, again, not this year's, whether it comes down to 2% or not, that is well known, that it will come down from 2.6 towards 2% or 2.1. What is more interesting is whether the 4.5% inflation that they've shown for FY27, whether that comes down towards 4% or 4.2, then you'll get a feeling that RBI is being more dovish by saying that the future-looking growth is lower than this year, and inflation also will be lower. What was your first question? I just forgot.
Okay, 30 seconds to go. Mr. Indranil Pan, are you expecting any change in stance? And what is your one-year ahead GDP and CPI number?
Okay, this year our headline GDP is 7.4. Next year it is 6.6. Inflation next year we are at 3.6%, and I think the RBI would reduce it to 4% or thereabout.
Okay.
And in terms of the stance, when you know as a central bank that you are almost near or absolutely at the end of the cycle, you can't change the stance from a neutral to an accommodative. So I'm absolutely ruling out a change in stance.
All right, moments to go. Thanks very much, all of you, for sharing what to expect. It is going to be a close call, so we're standing by to hear from the governor any moment now. As far as our experts are concerned, quite split again on the cut or the pause. But liquidity, that's something we're all going to be keenly watching out for, what the governor shows the market with, whether it is that 2 trillion number or lesser. And of course, the macro forecast will give us a sense of how dovish or not dovish the RBI wants to sound. We have the governor. Let's take a look.
In the last month of an eventful and a challenging 2025, we look back at the year so far with satisfaction. The economy witnessed robust growth and benign inflation. The banking system further consolidated, and the regulatory framework was refined to strengthen the financial system, enhance ease of doing business, and improve consumer protection. At the same time, we approach the new year with hope, vigor, and determination to further support the economy and accelerate progress. Since the October policy, the Indian economy has witnessed rapid disinflation, with inflation coming down to an unprecedentedly low level. For the first time since the adoption of flexible inflation targeting, average headline inflation for a quarter at 1.7% in Q2 this year breached the lower tolerance threshold of 2% of our inflation target. It dipped further to a mere 0.3% in October 2025. On the other hand, real GDP growth accelerated to 8.2% in Q2, buoyed by strong spending during the festive season, which was further facilitated by the rationalization of the GST rates. Inflation at a benign 2.2% and growth at 8% for the first half of this year presents a rare Goldilocks period. Globally, contrary to earlier expectations, growth has been relatively strong. Evolving geopolitical and trade environments, however, continue to weigh on the outlook. Inflation paths remain divergent, with headline inflation remaining above target in most advanced economies. Pressures in most emerging markets, however, are contained, providing them the room for accommodative monetary policy. Conflicting pulls and pressures from AI-fueled optimism and concerns over high valuations are playing out in global equity markets. Divergence in monetary policy trajectory of central banks is adding to the uncertainty on the capital flows and yield spreads. I will now come to the major decisions of the MPC and the RBI. The MPC met on the 3rd, 4th, and 5th of December to deliberate and decide on the policy repo rate. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to reduce the policy repo rate by 25 basis points to 5.25% with immediate effect. I repeat, the MPC voted unanimously to reduce the policy repo rate by 25 basis points to 5.25% with immediate effect. Consequently, the STF rate under the LAF shall stand adjusted to 5% and the MSF and bank rate to 5.5%. The MPC also decided to continue with the neutral stance. Moreover, in view of the evolving liquidity conditions and the outlook, the Reserve Bank has decided to conduct OMO purchases of government securities of 1 lakh crore rupees and a 3-year dollar-rupee buy-sell swap of $5 billion this month in December to inject further durable liquidity into the system. I shall now briefly set out the rationale for the decisions of the MPC. The MPC noted that the headline inflation has eased significantly and is likely to be softer than the earlier projections. This is primarily on account of the exceptionally benign food prices. Reflecting these favorable conditions, the projections for average headline inflation this year and Q1 next year have been further revised downwards. Core inflation, which had been rising steadily since Q1 last year, eased at the margin in Q2 this year and is expected to remain anchored in the period ahead. So both headline and core inflation are expected to be at or below the 4% mark during the first half of next year. In fact, the underlying inflation pressures are even lower as the impact of increased prices of precious metals in this inflation number is about 50 basis points. Growth, while remaining resilient, is expected to soften somewhat. Thus, the growth-inflation balance, especially the benign inflation outlook on both headline and core, continues to provide the policy space to support the growth momentum. Accordingly, the MPC unanimously voted to reduce the policy repo rate by 25 basis points to 5.25%, and the MPC also decided to continue with the neutral stance. I will now spell out in some detail our assessment of growth and inflation. First of all, growth. Real GDP registered a 6-quarter high growth of 8.2%, as you are all aware, in Q2. This is underpinned by resilient domestic demand amidst global trade and policy uncertainties. On the supply side, real GVA expanded by 8.1%, aided by buoyant industrial and services sectors. Economic activity during the first half of the financial year benefited from income tax and GST rationalization, softer crude oil prices, front-loading of government capital expenditure, and facilitative monetary and financial conditions supported by benign inflation. High-frequency indicators suggest that domestic economic activity is holding up in Q3. There are some signs of weakness in few leading indicators. GST rationalization and festival-related spending supported domestic demand during October-November this year. Rural demand continues to be robust. Urban demand is recovering steadily. Investment activity remains healthy, with private investment gaining steam on the back of expansion in non-food bank credit and high capacity utilization, which is of the order of about 75%. Merchandise exports declined in October amid subdued external demand, accompanied by softer services exports. On the supply side, agricultural growth is supported by healthy kharif crop production, higher reservoir levels, and better rabi crop sowing. Manufacturing activity continues to improve, while the services sector is maintaining a steady pace. Looking ahead, domestic factors such as healthy agricultural prospects, continued impact of GST rationalization, benign inflation, healthy balance sheets of corporates and financial institutions, congenial monetary and financial conditions should continue to support economic activity. Continuing reform initiatives, moreover, would further facilitate growth. On the external front, services exports are likely to remain strong, while merchandise exports face some headwinds. External uncertainties continue to pose downside risks to the outlook, while speedy conclusion of various ongoing trade and investment negotiations which the government is undertaking with various countries and jurisdictions present upside potential. Taking all these factors into consideration, real GDP growth for this year is now projected at 7.3%. This is up by about 0.5% from our earlier projections. Q3 is projected at 7% and Q4 at 6.5%. Real GDP growth for Q1 next year is projected at 6.7% and Q2 next year at 6.8%. The risks are evenly balanced. I will now move to inflation. Headline CPI inflation declined to an all-time low in October 2025. The faster than anticipated decline in inflation was led by correction in food prices, contrary to the usual trend witnessed during the months of September and October. core inflation CPI remained largely contained in September-October, despite continued price pressures exerted by precious metals. Excluding gold, core inflation moderated to 2.6% in October. Overall, the decline in inflation has become more generalized. Turning to the inflation outlook, food supply prospects have improved on the back of higher kharif production, healthy rabi sowing, adequate reservoir levels, and conducive soil moisture. Barring some metals, international commodity prices are likely to moderate going forward. Overall, inflation is likely to be softer than what was projected in October, mainly on account of the fall in food prices. Considering all these factors, CPI inflation for this year is now projected at 2%, again about 0.6% downwards from our earlier outlook. Q3 is at 0.6%, and Q4 moves up to 2.9%. CPI inflation for Q1 and Q2 next year are projected at 3.9% and 4% respectively. I may, however, add that the underlying inflation pressures are even lower, as the impact of increase in price of precious metals is about 50 basis points. The risks are evenly balanced. I will now draw your attention to the external sector. India's current account deficit moderated from 2.2% of GDP in Q2 last year to 1.3%. This is a decrease of about 0.9% in Q2 this year, on account of robust services exports, which continue to do well, and strong remittances. In October 2025, merchandise exports contracted YOY, whereas merchandise imports continued to increase for the second consecutive month. This resulted in widening of the trade deficit. Healthy services exports coupled with strong remittance receipts are, however, expected to keep our current account deficit for this year modest. On the external financing side, gross FDI to India increased at a robust pace during the first half of the year. Net FDI too increased significantly due to a decline in repatriation despite a rise in outward FDI. FPI to India recorded net outflows of $0.7 billion this year so far, basis figures till December 3, primarily due to outflows in the equity segment. Flows under ECB and non-resident deposit accounts moderated as compared to last year. As on November 28, 2025, India's forex reserves stood at a healthy $686 billion. This provides robust import cover of more than 11 months. Overall, India's external sector remains resilient. We are confident of meeting our external financing requirements comfortably. I will now talk about the liquidity and financial market conditions. System liquidity, as measured by the net position under the LAF, stood at an average surplus of 1.5 lakh crore rupees for the period since the MPC last met in October. Money market rates have remained largely aligned to the policy repo rate, which was 5.5%, amidst comfortable liquidity conditions. GSEC yields have remained range-bound since the last policy. In response to the cumulative 100 basis points cut in the policy repo rate, the weighted average lending rate of scheduled commercial banks declined by 69 basis points for fresh rupee loans during this period. In fact, the interest rate effect is even more at 78 basis points. The moderation in the weighted average lending rate of outstanding rupee loans has been to the extent of 63 basis points, which again is very satisfactory. The transmission has been very broad-based across sectors. On the deposit side, the weighted average domestic term deposit rate on fresh deposits has declined by 105 basis points, while that on outstanding deposits has softened by 32 basis points over the same period. I would like to take this opportunity to reiterate that we are committed to provide sufficient durable liquidity to the banking system. We continuously assess the durable liquidity requirements of the banking system, which happens due to changes in currency in circulation, forex operations, and reserves maintenance. Going forward too, we shall continue to do so. And after reviewing the liquidity situation and the outlook, as mentioned earlier, we have decided to conduct OMO purchases of government securities amounting to 1 lakh crore rupees in this month. Moreover, we will also be conducting a 3-year dollar-rupee buy-sell swaps this month. The details will be notified separately later today. We are hopeful that these measures will ensure adequate durable liquidity in the system and further facilitate monetary transmission. I would also like to clarify that injection or absorption of liquidity through purchase or sale of government securities under OMOs and that through operations under the LAF, which is VRR or VRRR, which are of short-term duration, serve very different purposes. While the objective of purchase and sale under OMO is to provide or absorb durable liquidity, the purpose, which is long-term, and the purpose of repo operations is to manage transient liquidity, which is of very short nature, so as to align the operating target, which for us is the weighted average call rate or the Walker, to the policy repo rate, which now stands reduced to 5.25%. So it is quite possible that on the one hand, we inject durable liquidity through purchase of government securities under OMO, while simultaneously withdrawing transient liquidity through a VRRR operation on the other hand. I would further like to reiterate that the primary instrument of monetary policy is the policy repo rate. It is expected that changes in the short-term interest rates will transmit to various long-term rates. At the same time, the primary purpose of OMOs is to provide sufficient liquidity and not to directly influence G-Sec yields. I will now talk about financial stability. The system-level financial parameters related to capital adequacy, liquidity, asset quality, and profitability of the scheduled commercial banks continue to remain robust. Similarly, the system-level parameters of NBFCs too are sound. They have adequate capital position, and they have improved gross NPAs. The total flow of resources to the commercial sector has been strengthened. This is bolstered by greater non-bank intermediation. In the current financial year so far, the total flow of resources was more than 20 lakh crore rupees, precisely 20.1 lakh crore rupees. This is against 16.5 lakh crore rupees in the corresponding period of the previous year. Outstanding credit from bank and non-bank sources put together increased by 13% year-on-year. Bank credit too has seen an uptick. The latest number that we have is 11.4%. Sector-wise, data reveals that growth was supported by sustained lending in retail and service sector segments. Industrial credit growth also firmed up, aided by buoyant credit flow to the MSMEs. Large industries too recorded an improvement in credit growth. Now, before I conclude, I have one additional measure to announce. You are all aware we have been focusing on improving customer services. We have taken a large number of measures in this regard. Re-KYC, financial inclusion, Aapki Punji, Aapka Adhikar campaigns are some of the initiatives taken in association with other stakeholders, including Government of India, Ministry of Finance. Earlier in the year, we reviewed our Citizens Charter too. We made applications for all our services online. We have the Prabha portal. Some 204 services are online over there. We are publishing the summary of our monthly disposal and pendency of various applications on the 1st of every month for the last 3-4 months now. And I'm happy to note that more than 99.8% of the applications are disposed of within the stipulated timelines given in the Citizens Charter. However, in the recent past, as a result of inter alia receipt of a large number of grievances, pendency with the RBI Ombudsman has increased. I therefore exhort all regulated entities to kindly keep customers central in their policies and operations, improve customer service, and reduce grievances. Further, in this regard, we propose to hold a 2-month campaign from 1st January next year with an aim to resolve all grievances pending with the Ombudsman, with the RBI Ombudsman for more than a month. I elicit the support of all regulated entities in this endeavor. Let me now conclude. Despite an unfavorable and challenging external environment, the Indian economy has shown remarkable resilience. It is poised to register high growth. The headroom provided by the inflation outlook has allowed us to remain growth supportive. We will continue to meet the productive requirements of the economy in a proactive manner while ensuring macroeconomic stability. Thank you, Namaskar, and Jai Hind.
Well, the governor has given everything that the market and the economy wanted. You've got your 25 bips rate cut and a little more than just the OMO. My sense is this is the first tranche of OMO. The governor has promised they're going to buy 1 trillion of bonds, 1 lakh crore of bonds. That liquidity will come in. Plus, there is this 5 billion swap that they're going to do, FX swap, which will also push in liquidity, $5 billion worth of liquidity into the system. We don't know the dates yet. That will be separately announced. But that explains why you have seen a good 5 basis point fall in the 10-year yield. The market's clearly celebrating. The rupee has been steady today. And the governor clearly indicated that they are watching every possible external data. That's about all he came to say in terms of the rupee. You know, what's the current account deficit? What is the deficit in October? What are the FPI and FDI flows? Usually so much details are not there on the external sector in the governor's speech. He just stopped short of saying something about the rupee, but otherwise he has given an extremely dovish signal. What I am waiting to ask the market is whether they are smelling another rate cut, because there was no indication that this is the end of dovishness, nor was there any indication that there is a long rope left. After all, it is still neutral stance. With that, let me invite our guests. Do we have the biggest banker? Do we have State Bank with us? Okay, let me first invite Mr. Ashwini Tiwari. We also have economists and bond dealers with us. But Mr. Tiwari, good morning. What have you made? This rate cut is going to once again push back margins, or do you think that, you know, it's going to be temporary? So one question on margins and another on how much might it push up credit growth?
So Lata, as you rightly said, there will be initial pressure on margins as it has been in the past. where the loan rates have transmitted quickly, but the deposit rates, especially the fixed deposit rates, correct only on maturity. So this process had been going on and would have finished in the next couple of months. But with this additional rate cut, this will push it back a little. So there will be some initial pressure, but as you rightly said, it will be temporary, and we hope to be back on track or back on even keel by the end of March, hopefully. However, this rate cut was, as you are aware, that even our house view was that maybe the rate may not be cut, but it has been cut. So overall, it's not going to make much difference as far as credit growth is concerned. We have seen very strong credit growth on the retail side. The demand is already good, and this may push it even further. That it's like a trigger. So we don't expect too much credit growth because of this, because it's already strong for us.
Okay. Is there anything else from the policy that stands out for you?
Well, the announcements are not that significant. I mean, in terms of the RBI Ombudsman scheme, which was highlighted, we are already focused on resolving all the complaints thereon, and therefore that is a continuous endeavor. I would say that the liquidity measures which have been announced are very welcome, both the OMO and the buy-sell rupee swap, because they will provide durable liquidity. And there was some pressure in terms of the bond yields and the government security, especially the state development loans whose auctions will be coming up in the last quarter. And they were kind of pushing up the rates a little. So that will now correct, hopefully, because of all this. So in that sense, that is more significant to me,
I mean,
apart from the policy rate cut.
No, I was expecting you to say that, because if it continues with this kind of liquidity, then hopefully you all are going to have some mark-to-market gains on your bond book as well by the end of the quarter. Let me turn to the economist, sir. Kaushik, what is the first impression? Rate cut as you expected? Was the liquidity measure more than expected?
So Lata, we are very happy because we expected both to be announced, both liquidity and RBI rate cut. So we got the 25 rate cut, which I think was overdue. And on liquidity, we had done a calculation that by end of March 26, RBI would need to infuse 1.5 to 2 trillion INR worth of liquidity based on the currency circulation leakage, the FX intervention. So we had a calculation in our mind. As of today, RBI has announced 1.5 trillion. If you see the 1 lakh crore OMO and 5 billion swap, that's about 1.5 trillion liquidity infusion. My guess is you'll get more by the end of March 26, another 500 billion at least. It will go up to 2 trillion. And in FY27, I expect more OMO purchases to happen to take care of reserve money growth. So this is just the start of the cycle to ensure that your 1% of NDTL liquidity is maintained for a longish period, so that transmission of this rate cut and the cumulative total 125 basis points rate cut filters into the real economy with the slowest amount of lag that is possible.
Got it. Well, the more important question, Upasana Bharadwaj of Kotak Bank is also with us. Are you smelling another cut? Because the governors seem to sound very dovish about inflation in the first half of next year as well. They have brought down the forecasts considerably. Where did they start? 4.9. Now they believe both core and headline are going to be 4 or below 4.